The PPP recently got extended. You have some tweaks that were recently signed into law just a few days ago, providing for the increase of forgivability in loans from a 2-month period to a 6-month period, and also allowing business owners, business recipients of PPP to have more flexibility in what they spend on the loans, not necessarily payroll-related expenses. For example, if a business owner wanted to invest a lot of money in a high-end air filter to kill coronavirus or filter coronavirus, and in that way ultimately have sustainable operations, now because of the tweaks and because of more PPP flexibility, the business owner is able to do that without facing the prospect of losing out on those loans. So certain well-targeted recent tweaks are really important. But in terms of some of the big, if I may, some of the big picture proposed stimulus measures, specifically on the state and local level. I mean, look, in the real world, you have states and localities, in particular what TPA has studied in the case of Maryland and New Jersey and New York. The asks of these governors far exceed the coronavirus-related losses. And on the federal level, you have the United States Postal Service. They're asking for an $89 billion bailout when the financials don't even remotely support that. So in the real world, what happens is you have localities, you have states, and you have federal agencies that get into a lot of financial trouble even preceding a crisis like the pandemic, and they have asks, financial asks for taxpayer aid that far exceed coronavirus-related losses, and they'll take that money and they'll use it to subsidize really bad mismanagement practices that, again, predate the pandemic. So we have to be very careful in any state and local aid to make sure that it's not a series of boondoggles. It doesn't result in waste of taxpayers. You already have diminished federal fiscal capacity because the deficit this year is already approaching $4 trillion. So we have to be very, very careful in future relief measures to make sure that we're not subsidizing bloated state and local government operating structures that are a drag on economic growth and not a contributor to economic growth.
Here's a few things I would say. First of all, the United States deficit is denominated in the currency that the United States can print. So the same reason why Japan has twice as debt to GDP as the United States, but can borrow for 10 years at 0% interest rate. There's no fiscal constraint, there's no bond market constraint to these deficits. It's primarily inflation, and we have aging demographics, we have a lot of private sector debt, and we have very high inequality. All three of those things are very disinflationary factors. Inflation is not spiraling out of control, and that's why the 10-year yield is at 1%, less than 1%. There's plenty of fiscal capacity. In fact, we could probably triple the deficit, and it wouldn't lead to any real fiscal constraints. I wouldn't argue that.
What about interest payments? What about interest payments at a moderately higher interest rate?
Well, again, the central bank determines the interest rates, which is exactly why the 10-year yield is under 1%, despite the fact that we've blown out the deficit. If you look at the correlation between interest rates and deficits, you'll see it at the state and local level because state and locals can't print dollars. But you will not see that in a monetarily sovereign entity like the U.S. government, the Japanese government, the German governments, the Swiss governments. It's a completely different fiscal constraint versus a household budget or a state and local budget. But on top of that too, we can go back and forth about the fairness or optimality of the state and local debts. And I have views, you have views, but what I would say is, one, the lion's share of especially blue state and local budgets being kind of like big and bloated is because they're basically replacing lack of safety nets on the federal level, which is why you see really, really poor outcomes in states that try to use tax cuts to generate growth, and then it never kind of works out. Not to mention, whether or not it's optimal or fair, it's going to have a very deleterious macroeconomic impact. If we're optimizing for growth, and if we're optimizing for entrepreneurialism, if we're optimizing for effectively capitalism, if we're optimizing for the engine of American growth, it's going to be macroeconomically necessary to expand state and local aid in order to prevent downside feedback loops from emerging.